Hey everybody, good to be here today. My name is Brent Moores, and we've got quite a market, and I want to talk to you about trading the market, these volatile markets right now, and so I want to look at the market. I want to talk about some approaches to trading this market. Of course, I'm not going to be exhaustive in covering every possible approach to the market, but I want to talk to you about some possible ways that you can approach this market. Hey, thanks for joining me, whether you're watching live or on a recording. I'm glad to have Mr. James Boyd helping me out on the chat, of course. So as you have questions, feel free to type those in the chat between James and myself. We'll do our best to get those questions answered. You can follow James or myself on X, by the way, at BrentMooreCS, at James Boyd CS for additional content. And before we get to the meat of the show here, let's just mention a few disclosures. Options do carry a high level of risk and are not suitable for all investors. The information I'm going to go through today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application is for educational purposes only. I may not factor in commissions in all the trades we show, but those are a factor that you should consider. Definitely, all investing does involve risk, including risk loss of principal. And remember, in paper money, short options will not be assigned early. That can happen in real life. Probability analysis results are theoretical in nature, and past performance of any security or strategy is no guarantee of future success. Let's go to the Thinkorswim platform to start off here. Okay, this is the market. I want to look at the markets here because we've seen a pullback. I'm not going to go through all the numbers, but we pulled back, I don't know, roughly 10%. But it's been a rapid pullback. And, in the midst of that, we've had a few up days. Today was looking a little bit more promising at the start. Let's look intraday here and just kind of see what we're doing. Yeah, we pulled back. This has just been like what we've seen lately. Intraday, we've seen this kind of thing, right? We gap up this morning. CPI data was good today. And so we gap up and then it sells off, and then this is just kind of par for the course, folks. That's how we've been. So from a broader standpoint, when we're looking at this, and I have a 20 and 50-day moving average, the question is, when are we going to bounce? And the answer is, I don't know when we're going to bounce. This is not the most convincing bounce, I would say, right now. We are a little bit higher than we were yesterday on the S&P 500, but that candle right there, I think for a lot of technicians, isn't a shining example of a reversal candle here at this point. Sometimes we talk about a close above the high of the low day. Well, I don't know where we're going to close today. We still have almost 4 hours to go in the markets, but what you'd like probably to see is a green candle there. Okay. And so I don't know. We'll see on this. But here's one thing that I do know, and that is there's a lot of uncertainty in the market. I know a lot of you are feeling that uncertainty, and you can see that reflected in implied volatilities. Here's the VIX over the last 6 months, and you can see we've peaked out at different times, and it's been kind of a short-lived. But notice the difference here in this. When we've peaked out in the past, it's gone up pretty quick and then reversed, gone up pretty quick and reversed, gone up super quick and reversed, up and back. This one, I was kind of thinking, well, are we going to reverse here? Are we going to reverse? No. I mean, we've pulled back a little bit today, but those higher implied volatilities are indicative of two things. Number one, higher implied volatilities mean option prices are higher because people's market expectations are higher. Okay? And you can look at these, by the way, implied volatilities on individual stocks. If I just pull up a stock here, MSFT, for example, Microsoft, for example, and I want to look at the implied volatility, it's a study, you can just add that study there. I have it pinned, but you can add that study and you can see those implied volatilities on the individual stock, and you can say, how high is it going to be? It means options are how high is it going to go? It means options are more expensive. And so sometimes the gut reaction is, oh, implied volatilities are high, therefore I need to be a seller in the market. But they're high for a reason. Implied volatilities are, what they're saying is, the expectation is we're going to get bigger movements in those options. Now, so you have to ask yourself, is that expectation of bigger movements in the option going forward true, or is it overblown? Is it priced correctly, or is it mispriced? If you feel it's mispriced and we're not going to have those super high expectations, then it probably makes sense to go short the market, short IV, I should say, and use a selling strategy and try and take advantage of those drops in implied volatility as the market settles down. But if you think the high IVs are accurately pricing the markets, you don't need to feel compelled to do that. So I want to talk about different approaches to the market today. And I want to focus on a couple specifically, but we'll talk about a couple more as well. One approach is that the market is volatile. Okay, well, we know that the market is volatile, but one approach is the market is volatile and that volatility is going to stay in play, that we're going to expect that volatility to continue. And that volatility may go up. Excuse me, the market may go up a ways, or it may go down a ways, but we're going to expect the volatility to continue. Now, maybe you think this is a bottom and you think it's going to go up a ways. Great, that's fine. I kind of gave you, I think, what a lot of technicians would say a few minutes ago. Some of you may feel this is just the start of something bigger. We're down about 10% on this. With a 20% pullback certainly isn't unheard of. So if you feel that volatility is going to stay in play, one approach you have is to plan on that volatility and to do a trade that's going to take advantage of it. Okay. That's going to be our first approach. I want to talk about that. Now, there's other approaches we'll get to in just a minute. But that first approach I want to take is not going to be a directional approach. Now, you can do a directional approach here, but my first approach is, if you think there's going to be high movement in the stock, in the index, in the market, whatever, if you think there's going to be high movement either to the high side or the low side, you can trade according to that without having to commit to up or down. And so the first strategy I want to talk about here today is a long straddle. Okay, a long straddle. So let me go, and I'm going to just pull up a stock. This is one that's been hugely in the news. The CEO of the company has been hugely in the news. And the market right now on Tesla, I measured this before, from high back in December to I think the low, so we've retraced just a little bit here on this. High to low was a 55% drop on this stock. Okay, 55% drop. So that's a big move. Can you see this going? Can you see this going down? Well, what would, if we went down to $200? That doesn't. As we're looking at this, $200 isn't that far away, given the movement that we've had there. But that would be, from a $248 price, that would be almost, that'd be right around a 20% drop in this, right? 20% drop is a big drop, but look at the graph. That's certainly not unreasonable. Similarly, if we went up to $300, and can you envision this stock going, well, wow, this stock got whacked really hard. It's likely to, when it reverses, maybe it's kind of like this rubber band. When it reverses, can it get up to $300 or $350? Is that possible? Certainly it seems possible to me. That doesn't seem out of the realm of possibility if the market were to turn around. So bigger movements are certainly possible. And if we want to take an approach where we're not going to commit to up or down, but we're just going to say, I think it's likely to move a lot. If you're going to take that approach, that makes sense. So let me just show you this. So here's what I'm going to do. I'm going to go out about a month here on Tesla because, look, a month in, things have been moving so fast that a month doesn't even seem like that long here. It seems like a lot could happen in a month. So I'll go out to the monthly options here. And what I'm going to do is I'm going to go to the at the money contracts. We'll go to 250 because the stock right now is at 249. I'm going to go to that 250. And if I want, I can change single to straddle. Okay. But just so you realize what a straddle is, for those of you who aren't aware, is it's buying a call and buying a put at the same strike. Now I could go through and add those prices. I could go, well, 23, almost $24, and the put's going to be about the same price. We're going to be in the $47, $48 range when you add those two together. I can also just go to straddle, go here, and we said, what, 250? There's the price. Okay, that's just adding them together. That's putting them both together for us. The price over here on this side and the price over here on this side is going to be the same because you're doing the same thing. But what this is saying is we're buying the long call and we're buying the long put for $4,700. I'm moving that decimal point over 2 spots there. Okay. $4,700. That's how much, or $47 times the 100 multiplier is the other way to do it. I'm just rounding a little bit here. What's our break even on this? Well, our break even is essentially going to be the strike price plus this amount. So 297, or the break even minus this amount, which is going to be 203. Now, those are more or less in line with, I said, plus 10% move, down 10% move. My math probably isn't exact on that, but it's pretty close, I think. Okay, that's more or less a 10% move up or down. Is a 10% move up or down in the market right now? Well, in most markets, I say a 10% move sounds like an extreme move out 36 days. In this current market, 10% move seems a lot less, doesn't it? So let's look at this trade here. And just before I do, though, just how does this work? Why are those the break even? Well, if I'm paying a total of $47 on this, I need either the call or the put to be worth $47 or more at expiration for it to be profitable. Okay, initial cost, initial debit is $47. If the stock goes up a ways, that put is going to go worthless, basically. Okay, we'll just stick with that scenario for a sec. How much is the stock going to be worth? How much is the long call going to be worth if the stock goes up to, say, $200? Well, if it's a 250 strike, a long call is going to be, did I say 200? I meant $300. If the stock goes up to $300, it's going to be worth about $50 of intrinsic value plus any extrinsic value at that point. Okay, so that's how we're getting a break even. Similarly, if the stock drops down, how much the call is probably going to be worthless, basically. But if the stock drops down, how much is it going to take for the put to be worth at least $47? Well, it's got to go at least $47 below the 250 level. Okay, so let's look at this trade. Let's go and let me go here, and we said it's 47 plus or minus our strike. Well, the strike was going to be 250. Let me just draw a line right at 250, which is right where the stock is. Okay. So that was 297, which is going to be right about there. Okay. It's going to be 203, which is going to be right about there. Makes sense? That's the trade right there. This is a profitable zone, theoretically. This is a profitable zone, theoretically. And those are supposed to be pluses. Let me go red. This is the zone we don't want it to be in. We got 36 days on that trade. Okay. So let's put the trade in. Okay. So what I'm going to do is I'm going to go back here. I'm going to go to trade. I'm going to go to the 250 strike. I'm going to click on the ask price. Doesn't matter which ask price I click on. Click there. There's my long call. There's my long put. And I can confirm and send. And we'll just put that. I'm just going to leave it unallocated for now. So I'm going to send that trade. And we'll see, we filled on that. We have a long straddle. So that's an approach. You can just go with the zeitgeist right now, which is, look, the market's crazy. You guys have all experienced that. And I'm going to plan on this moving a lot, up or down. I'm not taking a side on whether it's going to go up or down. I'm just saying it's going to move a lot. Now, there's alternative approaches. If I want to be more directional, I could just do a long call. Is the implied volatility, if we get an implied volatility drop, is that going to hurt the long call? Yeah, it will. If I get an implied volatility drop, will it hit a long put? Yeah, I will. But if I'm directional and I get the direction right, I'm there. You can also do a synthetic. Okay. Implied volatility drops aren't going to hurt the synthetic as much. But again, that's a directional trade. Why do IV drops not hurt the synthetic? Because you have one long option and you have one short option on a synthetic. Okay? I'm not going to get into that right now because that's just, I have to limit what I'm talking about so I can get through everything today. But you have a one long option, which is going to be positive vega, and you have one short option, which is going to be negative vega on a synthetic. So they kind of cancel each other out. So that's another approach if you want to take the directional approach to things there. Okay. Now, Greg said in the chat, it could gap up or gap down. Should we put in a target price? You can. I'm not planning on it because if it gaps up or gaps down, that's great. I want it to gap down. I hope the bigger the gap, the better for the Tesla trade here on this one. On this example trade we're doing on Tesla, the bigger the gap, the better. And if it does gap, it's kind of like when we talk about a stop loss. When we talk about a stop loss, let's say we said, well, look, if it gaps up, I want to put a stop on the put and get out. It's probably not going to save your put if the stock gaps up a lot. Your put's probably going to instantly go to something very small amount on that. So yeah, you can. I don't want to dismiss that as a possibility there, Greg, but I welcome the gap here for this sample trade. Let's talk about another approach to the markets here. Okay. And that is this. Instead of embracing the volatility, we could say, hey, look, the market volatility, as we can kind of see in that VIX, is kind of high. Typically, when we see implied volatilities high, they don't stay high. The market kind of corrects itself. Okay. The market kind of corrects itself after a while. In other words, it kind of acclimates to where the market's gone and the volatilities drop. And so when I see a VIX up here, and I assume, well, it's, maybe it won't go down to low teens anytime soon, but maybe it goes down to high teens before too long. We can try and take advantage of that with a negative vega trade. negative Vega trade, planning on that implied volatility drop. So in other words, negative Vega trade, those would be trades that are typically like short calls, short puts. Now, typically we don't just do a short call because they have unlimited risk. Covered calls, okay, negative Vega benefits from drop in implied volatility. Short puts, okay, short put verticals, short call verticals, okay, short straddles. Again, short straddles, which is just the opposite of what we did before. We did a long straddle where we did long call, long put. Short straddle is short call, short put, unlimited risk. So I'm not going to even demonstrate that today. So there's different trades that we can do to kind of take advantage of do a negative Vega trade here. But the one I want to do is I'm going to look at a different stock. We looked at Tesla. And I'm going to look at one that has kind of higher implied volatilities. It's kind of been through the ringer. It's shown a nice little bounce. Now, when earlier we were looking at that SPX and I said, that bounce we were looking at from a technical standpoint, I think wasn't going to get that many people excited. Let me just go back. Maybe it's changed in the last couple of minutes. That red candle, it's a little better than we were looking at a few minutes ago, but I'm not sure. This actual bounce on Boeing, that's a little bit better, okay? That's looking a little bit better. Now, I don't know where this is going to go. We're up 1.5% today. Had a nice bounce yesterday. But my approach here on this is going to be one where we're going to take a negative Vega approach. We're going to assume that the big moves that we were kind of banking on Tesla aren't going to happen, that it may move up or down a little bit, but not within a range. So I'm going to look at an iron condor here on on Boeing, okay, on Boeing. So let's do that. Now, an iron condor, for those of you who aren't familiar with it, is a trade where we're just going to do a short call vertical, a short call, long call, above where the current price is, and a short put vertical, short put, long put, below where the current price is, with the hope that the stock stays in between those short contracts. Okay, and if it stays in there, great. Furthermore, if implied volatilities drop, even better, because which you would think they probably would go down if this kind of mellows out here in this middle range, you'd probably expect, I think, implied volatilities to drop. Okay, I can't make any guarantee on that. So here's what we're going to do. We're going to go out, and I'm not going to go out as far on this one. Number one, I'd like to have some of these higher implied volatilities. You can see implied volatilities generally kind of go down the farther out you go. If I can get one of these higher implied volatilities, I'll go out about 3 weeks, 23 days here. And I don't want straddle on there anymore. Let me go to single. And what I'm going to do is, the hope is those 44% volatilities, which are fairly high, will drop. But what I'm going to do is I'm going to go to the call side. I'm going to look here, and I have a delta. Now, what delta is it tells you how much that option is going to move in relationship to $1 move in the stock price. Well, we can also use it as kind of a way to kind of come up with a strike to choose. Okay, why do we do that? Because it kind of, the 24 delta kind of implies a 24% chance it goes in the money, which we want a lower chance it's going in the money. Okay, so I'm going to sell that call. Okay, I'm going to go down and I'm going to make it $10 wide. If you look at the Vega here, this is going to be short Vega, this one we just clicked on. This is going to be long Vega because this is going to be a long contract. So essentially on the call spread, we're taking the difference between those two. By making it a little wider, I'm increasing the difference between those two. So I'm going to click on my long one. I'm going to hold down Control key. Okay, let's go to the put side. Put side, I'm going to go to my delta. We'll go down, well, I'll do 145, 23 delta. On these, typically I'm looking for some, in this class, we often look for something in the order of maybe a 20 delta on an iron condor. There's no 20 delta, and I'll go to the 23. What I want to do though is, so I'm going to click on the bid price. I'm going to sell the 145. I'm going to hold down my control key. And then what I'm going to do is I'm going to go to my long. And again, I'm going to try and maximize the difference between my Vegas. I'm going to make it a $10 wide. By going a little wider, we're adding a little more risk, but we're also adding the credit is going to be a little better. So I'm going to hold down my control key, click on that, and voila, we have an iron condor right there. Okay. So let's take that and let's analyze this. I'm going to right click on this. I'm going to analyze this trade. Here's Boeing. Okay, let me just make sure I don't have any extraneous older trades down there, which I do. Let me go and just delete that. I think that's what we're looking at there. Okay. And let me just kind of zoom that down. Okay, so this is where we're at. And what was our expiration date? We said April 4th? April 4th. Okay. And so today's the 12th, March 12th. We're going to want that there. Here's April 5th. And what I want to do is I'm going to click here. I'm going to set my slices set slices to break even, first of all. So showing about a 62% chance, and these are just theoretical probabilities of being at break even or better. That's great, but we risk more than we make. We potentially risk more than we potentially make. Theoretically risk more than we theoretically make. That's the price you pay for the higher probability. Now, the good thing on iron condors is, let's say the stock goes way up. We'll certainly probably be in a losing position, but we can't lose on both sides. So we have two break evens on this. So the put side will probably be doing quite well if the stock went up. Call side, not so much. But let's do this. Let's click over here and add the slices to the chart itself. So I'm going to go set slices to chart. Go right here. There's our Boeing chart. These two horizontal lines represent our break-even points for this trade. Okay, so that's an iron condor. Now, if you can do technical analysis, you can see this. I mean, if I were to say, where's your support down here? The lowest support I'm seeing on this is down here, which is a little bit below where our break-even point is. But just realize that's break-even. That's not a max loss by any means. And even if we were to go down here relatively quickly, let's say down to 135 relatively quickly, or up to 180 relatively quickly, we would probably be quite a long ways from a max loss on that, because there would still be extrinsic value in the options. So don't take max gain or max loss, when we look at those theoretical max gains, max losses, as likely max gains or max losses before expiration, because there's extrinsic value left in those options before that time. Now, that's great if it goes against us. The thing is, it's not so great if it works for us. If the stock stays around 160 in 2 weeks from now, we're still not going to be probably anywhere near a max gain on that trade. So these iron condors can be kind of slower moving trades, but that's kind of what you just gotta expect and deal with there. So from a technical standpoint, now that's a bounce. I would consider this kind of a support level, which probably matches up pretty well here. If I can keep my hand steady drawing, that's kind of oops, a little bump there. That's kind of my support level there on that. There's primary support level, and then we can go below. Resistance level, well, I would say probably this low here is probably a reasonable kind of resistance level on that. Can they break? Sure, they can break, but that's the goal. So from a technical standpoint, if this is a play that we're going to stay in between here, and that's number one. That's the analysis move. Number two is the associated assumption that implied volatilities will drop if the stock mellows out, so to speak. Okay, so that's a second approach here on this. I already talked to you about some different approaches that can take advantage of a drop in implied volatility if you want to be a little more directional. Short puts, short put verticals, short call verticals if you want to be bearish, and we talked about that. Okay, now let's talk about another approach in the market, and one I'm not going to, I don't really have anything to demonstrate on this one, and that is, one approach is if you're looking at the market and you're going, dang, this is crazy. I'm just going to sit on my hands, so to speak, and wait until I get a more convincing bounce. Now, waiting for a more convincing bounce before I get in, and presumably maybe you go long at that point, long stock, long option trade, long call, whatever. Does that mean you're going to get in at the very bottom? Let's say, for example, this was the very bottom. Yesterday represented the very bottom right there. Let's say that for a sec. If that were the case, we missed that, right? Was there somebody out there that got just extraordinarily lucky? That's all. That's the only word for it, folks. It would be lucky if you happen to catch that. If this continues to go up, and caught that. Yeah, you know what? That Okay. Hey, sorry. I guess we lost me for just a sec here, folks. All I was saying is, look, you may have got in real lucky here, but if you are waiting for the bounce, then yeah, you're not going to get in at the very bottom. Okay? You're not going to get in at the very bottom. Another thing we could do is we could just say, hey, look, what is going to convince us? Let me get rid of this and let me put on, I'm going to make this one a 200-day moving average here. Okay? We're going to make this 200 instead of 20. Apply. Okay. Maybe this is your line. Maybe this is kind of a level where we had that mini gap there, which coincides pretty much with that moving average. Maybe a break above that is what is going to convince you that this is, yeah, did you get in at this point? No, you didn't. But if you keep your capital on the sideline, so to speak, and jump in then, maybe that's another approach for you to consider. These are all, none of these are suggestions. These are possible approaches. And then you can go long here. Okay. And then I guess the other one is you can just take and this is I kind of mentioned this before. Another approach is you can just take a directional approach on the market. I mean, we took one that was kind of a volatility-based approach. It's going to move. We don't know which direction. We took one where we said, well, maybe it's not going to move as much. Try and take advantage of the Vega on the trade. And we said we could sit on the sideline, so to speak. But another approach is if you're convinced that this market is going to continue to go down, and I'm not going to do a sample trade on this right now, but if you think this is just the start of more to come, you can do a long put. Is implied volatility going to help you on that? No, implied volatility probably, may not particularly hurt you, because if the market continues down, it's unlikely the IV is going to drop much in that case. If IVs stay about where they're at, it may help you. Or if you're bullish and you just take a bullish stance and do a long call, IVs will almost certainly not help you on that, but that's okay. Sometimes we can get caught up with, theta or vega, but when we talk about those three main, talk about our three main Greeks here, delta, theta, vega, the three main Greeks that we talk about in this class typically, okay? Which is the one typically, if the market moves a lot, that's going to affect you the most? This one right here, delta, okay? Delta. You can have theta go your way, you can have vega go your way, but if the stock price goes against you, it's probably all for naught, to be honest. Similarly, if the stock price moves significantly your way, some time decay and some IV problems are probably something you're willing to take, right? Something you're willing to take there on that. All right. So that's the other approach. I'm not going to put a demonstration trade on with that one right now, but you can consider long calls, long puts in that case. Okay. So there's four different approaches to this market. Now let's talk about managing some existing trades here. Okay. So one thing I want to point out is this. A couple weeks ago, so I have a stock portfolio, and that stock portfolio has been hurt. These are just long stock here. And this has been kind of hurting a little bit the last few weeks. I'll tell you that. Last couple of weeks. And when did we put this on? On the 19th of last month. So what is that? About three weeks ago or so. We said, hey, we're a little bit concerned about this market. And so we put on a hedge. Okay? We just did a long put on the XSP options, which are mini S&P 500 index options. We looked at it and we said the SPX options were probably were not a hedge so much as just a very blunt instrument to go super bearish on the market. And look, in hindsight, would have that been great? Yeah, but look, I didn't know the market was going to fall as much as it did, but we were a little bit concerned, so we did this. Well, look, my stock portfolio it's struggled, admittedly. These are longer term stocks, has admittedly struggled over this time period. So we put on that hedge and it certainly helped us out here. The question then becomes, when do we take off the hedge? We still have 30 days until expiration on this. So there's no super duper urgency to get out. And what I'm going to say is this. If we had a more convincing bounce, then maybe we take off that hedge at this point and capture the profit. Now, let's say this bounces up here. Is my XSP long put going to suffer from that? Yes, it will, but the rest of the portfolio should benefit from that, and that's okay there. So the hedge is not meant to be a permanent part of the portfolio, but I think if we were kind of in this, I don't know, DEFCON stage level or whatever, red flag, yellow flag, green flag stage, I think a lot of traders would still call us in a red flag condition here. All right. So I'm going to leave that hedge on there. And so there we go. So in terms of your stock, this is the managing an option portfolio class. So we talk primarily about options, and I'm not going to manage the stocks here in this, but that's how an option portfolio can help your stock portfolio, because the assumption is not that your portfolio is 100% options, right? Okay. So, and look, that hedge, I have plenty of trades that don't work out on that. That one happened to work out. So I'm not trying to say that we're going to expect that in the future or anything because more often than not, those hedges don't necessarily work out that well. Okay. In fact, some of the stocks options we have in here aren't working out so well either. For example, we have a Comcast short, put, vertical. Now we're under that 10-day mark. Remember, under 10 days is the time on most of these option trades we talk about, is especially short option trades. We're saying, well, it's time to get out probably. And in this case, yeah, we're losing money. We lost 150 bucks on this guy. Okay. Yeah, not, and now the one exception to this would be, you know, we could possibly hang on if we've lost almost everything we can potentially lose on this, but there's still some more we can lose on this trade. IV may be helping us a little bit on this, higher implied volatilities, but I think it's time to get out and salvage what we can in this trade. So I'm just going to click on this. I'm going to right click. I'm going to create a closing order, and we are going to buy this trade back. That's a mid price. Okay. So, and it's moving a little bit. Just a note on this. That mid price is probably ambitious. The longer I'm talking, the worse it's getting for me. But I think it's an important point, so we'll risk that. Okay. This is what I'm going to say ambitious. We're probably not going to get filled if we try and fill it at that mid price right now. That's the default on Thinkorswim. By the way, Thinkorswim desktop platform is put in spreads in at the mid price. Single leg options will default to the natural price. Okay, here's the natural price. We probably wouldn't have any problem getting filled at the natural price. Now, the reality is what we'd like to do is we'd like to be able to buy it back for as cheap as possible. I'd like to buy it back at that mid price, but that may be a little less realistic. Probably more confident getting out of the natural price. So what I'm going to do is I'm going to go in the middle and try to pay a little less. Let me get rid of that drawing tool. Try and pay a little less. Wow, that just shifted on me big time. Okay, try and pay a little bit less than I otherwise would, and confirm and send, and we're going to send that option. Okay. Another one, you know, we're going to say, we're balancing out the hedge. The hedge, which looks so great, is AMD, which I looked before the class. It filled, I don't know if you noticed, it filled just a few minutes ago on this. And we lost money on this. We can look back and see what we lost, but I had a stop loss on there. And that's why we put in stop losses. We don't want to lose everything we could lose on that. And so, well, Wiley, I love it. Love it. I have some sentiment in my house that, you know, my wife and 3 daughters may agree with you on that, Wiley, in the chat. So let's talk about AMD here for a sec, okay? So let's just go back, and this will be our last one because we're going to have to wrap up here. But let's go to our trade history on AMD, and just recently, what do we got here? 105. Okay, so we did. Oh, that's right. We messed up on that. I initially entered the order wrong, and it instantly got us out. Okay, but this was the trade. We got in at 1110. We put in a stop at 780, and there we're at. So we lost money on that. How much did we lose? Let's see, like $330 overall on this trade we lost. And so there you go. I mean, the whole purpose is to live to trade another day. That's why we use hedges. That's why we use stop losses, even though stop losses aren't guaranteed. All right, so let's summarize here. We talked about 4 different approaches here in this market. One is just to play into the volatility, not go directional, but plan on a big move up or a big move down. To illustrate that, we did a long straddle. We talked about trying to take advantage of maybe thinking things calming down a little bit If we just calm down a little bit, the market's calmed down a little bit, implied volatility is dropping, and doing something like an iron condor, okay? Taking advantage of the drop volatility. We talked about just sitting on our hands, waiting until that signal you have to get in gives you that signal, and maybe that signal is not there, and that's when you get out. And number 4, we talked about taking a directional approach when you like. Maybe it's now, and just doing long call, long put. Okay, thanks everybody. There's a survey link. I missed that survey link before. I apologize on that. Please fill out that survey before you go. I gotta go, but we're grateful for you. Coming up next, we've got trading price patterns. Kevin Horner is teaching that one. Survey link. Bye-bye, everybody. See you later.